Everyone is saying silver is finished, not struggling, not delayed, dead. Retail investors are walking away. Dealers are quieter than they've been in years. Online forums that once screamed buy silver now are suddenly filled with doubt, sarcasm, and regret. The enthusiasm is gone. The patience is gone. And confidence? That vanished a long time ago. Silver didn't crash dramatically. It did something worse. It disappointed people slowly. It moved sideways while everything else ran. Stocks surged. Crypto exploded, collapsed, then surged again. Gold flirted with record highs. And silver stayed stuck, heavy, and frustrating. For many investors, it felt like wasted time, dead money, a bad decision they no longer wanted to defend. That's why the phrase silver stacking is dead is spreading so fast. Not because silver failed, but because people gave up waiting. And that is exactly where this story begins. Because history shows something uncomfortable. When an asset becomes boring, ignored, and emotionally exhausting, it usually isn't dying. It's entering the most dangerous phase for people who aren't paying attention. Silver is in that phase right now. The biggest mistake investors make is assuming price equals value. If something isn't moving, they assume nothing is happening. But markets don't work that way, especially not silver. Silver moves quietly for years, building pressure, while attention is elsewhere. Then it explodes so fast that most people miss the move entirely. That pattern hasn't changed. What's changed is the world around it. The United States is sitting on historic levels of debt, not theoretical debt, real compounding, unavoidable debt. Every year, interest payments alone consume more of the federal budget. Rate hikes were supposed to fix inflation, but they only exposed how fragile the system really is. High rates can't last forever, and everyone at the top knows it. When rates eventually fall, it won't be because the economy is strong. It will be because the system can't survive them anymore. That moment matters more for silver than almost anything else. Silver is not just an industrial metal. It is not just a commodity. It is a monetary metal trapped inside an industrial disguise. And when confidence in currency weakens, silver doesn't ask for permission to reprice. It simply does. The problem is that most people don't understand how rare physical silver actually is. Unlike gold, silver is consumed permanently. Once it's used in electronics, solar panels, medical equipment, military technology, or data infrastructure, it doesn't come back to the market. It disappears. That means the silver supply isn't recycling the way people assume it is. At the same time, silver mining isn't responding to demand. Most silver isn't mined on its own. It's a byproduct of copper, lead, and zinc mining. That means even if silver demand doubles, supply doesn't automatically increase. Mining companies don't open new silver mines just because the price ticks up a little. This creates a structural problem that the market keeps ignoring. Industrial demand keeps rising. Investment demand fluctuates, but supply remains stubbornly tight. Now layer that on top of what's happening in the United States. Manufacturing is being reshored. Energy infrastructure is being rebuilt. The push toward electrification, grid expansion, defense spending, and artificial intelligence isn't slowing down. Every one of those sectors uses silver, not optionally, necessarily. And yet, silver inventories are shrinking. The paper market hides this reality. Futures contracts, ETFs, and derivatives create the illusion of abundance. But paper silver is not physical silver. And when stress enters the system, paper claims don't matter nearly as much as people think they do. This is where 2026 becomes critical. By 2026, the United States will likely be facing a combination of slower growth, mounting debt pressure, and renewed monetary easing. That combination has historically been explosive for hard assets. Not immediately, not dramatically at first, but relentlessly. Silver doesn't respond to headlines. It responds to conditions. And those conditions are forming quietly. Most retail investors are positioned incorrectly. They either overexposed themselves emotionally years too early, or they exited entirely out of frustration. Meanwhile, institutional players are not chasing headlines. They're positioning for imbalance. Silver thrives on imbalance. When demand exceeds supply even slightly, the silver market doesn't adjust smoothly. It snaps, liquidity disappears, premiums spike, delivery delays increase. Suddenly, the price doesn't reflect availability anymore. That's when the narrative flips overnight. The same voices calling silver dead will start asking how high it can go. This has happened before. In the late 1970s, silver was ignored until it wasn't. In the early 2000s, silver was dismissed until it tripled. In 2011, silver shocked almost everyone by how fast it moved. Each time, the pattern was the same: long boredom, long disbelief, then sudden repricing. The current cycle fits that pattern uncomfortably well. But this time, the stakes are higher. The United States is no longer operating in a low debt, high trust environment. The global monetary system is more fragile, not stronger. Currency confidence is thinner, geopolitical risk is higher, and industrial dependence on silver is deeper than it has ever been. This creates a situation where silver doesn't need hype to move, it needs stress. And stress is coming. That doesn't mean silver will skyrocket tomorrow. It means the conditions that suppress silver are weakening, slowly, invisibly, but decisively. By the time the price reflects reality, positioning will already be late. This is where many people misunderstand stacking. Silver stacking was never about quick profits. It was about asymmetric risk, limited downside, explosive upside, protection against systemic failure. That thesis hasn't died, it's been delayed. Blind stacking is dangerous. Emotional stacking is dangerous. But strategic accumulation during periods of neglect has historically been the most effective approach. That's why calling silver dead is misleading. Dead assets don't face supply constraints. Dead assets aren't essential to modern technology. Dead assets aren't quietly being absorbed by industrial demand. Dead assets don't sit at the intersection of monetary risk and physical scarcity. Silver does. By 2026, the market will be forced to reconcile paper assumptions with physical reality. That doesn't guarantee a straight line upward. Volatility will be brutal, pullbacks will be violent, sentiment will swing rapidly. But the floor is rising. A conservative scenario places silver significantly higher than current levels, driven simply by monetary easing and steady industrial demand. A more aggressive scenario, triggered by currency instability or supply disruption, pushes silver into price territory most investors aren't psychologically prepared for. And if confidence in paper markets fractures, even temporarily, silver won't wait for consensus. It never does. The real question isn't whether silver stacking is dead. The real question is who still has the patience to hold an asset the world refuses to understand until it's too late. Because when silver finally moves, it won't announce itself politely. It will remind everyone why it was money long before it was a commodity. And by then, the people who called it dead won't be asking if silver can rise. They'll be asking why they didn't see it coming.